Okay, welcome to the Rich Dad Stockcast with Andy Tanner. Today we're going to be talking about how to make money when stock prices fall, which I'll double check this with Andy, but I believe that's a very unique trait of stock trading, that it doesn't matter if the stock market goes up or down, you're making money. So let's go ahead and bring Andy in and get straight to it, because that's my first question. How you doing, Andy?
Hey, I'm doing great, Greg. I'm doing pretty great. I've got a bit of a frog in my throat. I've had a cold, so we'll punch through. But it sounds worse than it feels, so I feel pretty good.
Hey, you sound sexy. Don't even worry about it. But if you'd like to hear Andy Tanner's voice when he doesn't have a frog, and I do want to put this out, Andy, real fast. Like I said, the name of this course is How to Make Money Even When Stocks Fall. Andy actually made a special training that you can
Web
get.
class,
Web class, where he'll go into much more detail. This is a 30-minute show, so you're going to get the big picture. But if you click on the link in the description, you'll get to hear Andy's, detailed version of this, his web class. And so I just want to make sure I get that out, because I so often forget to tell you about all the free stuff Andy gives you. So while I'm at it, make sure you click subscribe, write a comment. This show did not come from the comments. I apologize. This came from our last Stockcast show, where we were talking about
borrowing stock.
Yeah, there you go. Thank you. We were talking about how to borrow stock, and I got a little baffled, a little confused, and so Andy was kind enough to say, "Greg, you're an idiot," but I'll help clarify this for you.
I never say that. I never say that.
That might have been my own inner voice, but it was something like that. So, Andy, just go for it before I just keep blabbing. How do you make money when the stock market falls?
Well, you mentioned that this is unique to stocks, and I think there's, if you hunted well, you could find other places that do it. You've got, you can do it in the Forex and other places. But I would think, I'd say you're accurate in that the stock market is the predominant place this happens. If someone wants to, you have the Big Short, where they did it in the lending market. They got some derivatives on CDOs, but the stock market is the place where you'll predominantly hear someone do this. They're going to take a position where they're going to place a bet, essentially, that something's going to fall. And if you remember the big brouhaha with GameStop, they went after some of these people that had what we call short positions. And so this is something that's done opportunistically. It's something that I've done before. I think that it's not the mainstay of what you do. I think it's something that's fun and something that comes along once in a while that you pounce on. I think that your main foundation is always going to be to own assets, and to own assets that produce cash flow. So this is a capital gain play. This is when we're going to sell high and buy low. And it's so foreign to people, right? I love sharing this with people because I love watching the reaction of, because it seems so strange that you could earn cash by having something lose value. How do you earn cash when something loses value? So I enjoy, we'll try to describe it as best we can verbally for the audio. But I would recommend, I in that little course you mentioned, I do it in 3 or 4 different ways, and by seeing it done in various ways, and I get a draw, it really helps to draw arrows and show prices falling and how that seesaw works. And so I'd encourage everyone, if you have an interest and you want to go further and actually try to do it in your paper trade account, take that little hour and a half course, and you'll be paper trading in no time.
Right. And that's in the descriptions, everybody. Andy, you just said something interesting. You said, did you say sell high, buy low?
Yeah. Let's start.
Everyone else says buy low, sell high. Was that intentional, what you did there?
It absolutely is, because that's how it works. The way when I do I don't travel anymore, but back in the days where I teach live, big rooms, the way I always started this is I had people grab their pencil. I say, everyone grab your pencil. They grab it. They hold it up high. I say, switch hands and now write your name. And so they were all writing their name with their offhand now, right? And I asked them, "How does that feel?" And they say, "Well, it feels really awkward. It feels almost painful for some, and it sure doesn't give a great result." And I said, "Does that mean it's wrong?" And they said, "Well, no, there's nothing ethically or morally wrong about it. It's just not what I'm used to." I said, "Bingo." And Robert Kiyosaki, I love how he says this. He says, "Think about things as opposite, rather right and wrong." In other words, I don't have a right hand and a wrong hand. I have a right hand and a left hand, and neither of them are wrong. And so my basketball coach, Rick Majerus, couldn't say the word ambidextrous. We'd say, "Yeah, this guy can dribble with both hands. He's amphibious." So whether you want to shoot on the water or on the land or right with both hands, it's ambidextrous. But yeah, there's nothing wrong with doing this. So we have this idea of opposite. And so generally you would want to buy low and sell high if you were owning a stock, right? But since we're and if the stock was going up, obviously you'd want to buy low, have the stock go up and sell high. And you do the buying first and the selling second. But because the direction of the price is going to change here, it's going to go in the opposite direction. The prices are going to be going down. We're actually going to sell it first and buy it low later. And think about that. That still works. You're still selling at a high price and you're still buying at a low price. So in both scenarios, whether you're long or short, you're buying low and you're selling high. It's just in the case of going long, you buy first because the stock goes up and sell second. And in the case of a short position, you sell first and buy second, but you're still buying high, or excuse me, selling high, and then you're buying it low.
Okay, I
And
just gotta
there's
pause you. I gotta pause you. How are
that's
you
kind of
selling
freaky.
something how are you selling something you don't have? You're selling high, but you
You
don't
are. And
you didn't buy it yet.
and you described what's weird about it beautifully, because how do I sell something I don't own? So that goes back to last week, actually, when I said, "Hey, what do you do? Will you borrow some stock?" And if I borrow it, picture it this way. If I the thing, it was funny, I got ripped off on this on TikTok a lot. It was funny. I think I did originate this idea years and years ago, and people really like this. And there's a kid in Malaysia or something that stole it and did a TikTok. It just got like 1,000 million views. It was pretty funny. But the analogy I would use years and years ago uh, is I would say, "Let me borrow your phone. Let me borrow your iPhone." Because we know that an iPhone will go down in value. They're going to come out with an iPhone 7, 8, 9, 10, 11, 12, 30, 40, 50, right? They keep coming out with more of them. And every time they come out with a new one, the price falls. So that's what our discussion is, isn't it? It's how to make money when a price falls. So I could take my iPhone, and I'm cheap. I don't buy a new one every time. I think mine's still a 14. I'm sporting a 14 iPhone. What do they have, like 16 or 15 now? I don't know what it is. But I know that when they come out with a new one, this will go down in value. The iPhone 14 will go down in value. And so think of it this way. If I borrow your phone, Greg, if I
Mhm.
borrow your phone, what do I owe you? I owe you a
You owe
phone.
me the phone. Yeah.
I don't owe you any money. I didn't borrow money. And so if I hand that phone back to you, we're square, right? I
Right.
borrow it and it back. So let's say I borrow it for a indeterminate amount of time, and I sell it on eBay. So that's a transaction that could happen in real life, isn't it?
Yeah.
I mean, literally, and someone might say, "Well, that feels wrong to sell something that isn't yours."
You're gonna say it's a
Well,
little jerky.
there's nothing wrong with doing that as long as I return the phone to you. As long as I give you. Now, we'll assume the phone is fungible, right? We'll assume one iPhone 14 is the same as another iPhone 14. It won't be actually Greg's original phone, but if stocks are fungible, a share of Exxon is a share of Exxon, no matter if it was that specific share of Exxon, right?
Right.
And so I owe you a phone, man, and I can. There's absolutely nothing illegal about me borrowing that from you. And what would be illegal is if I didn't give it back to you, right? Then
Mhm.
I'd be stealing. So borrowing turns to stealing only when you don't return what you borrowed, right?
Right.
So I owe you this phone, and let's say the phone is worth on eBay, I don't know, let's say $600. Fair enough.
Yeah.
It's $600 or whatever, and I sell it. So that's two steps: borrow and sell. So that allows me to do selling before I do any buying. I've borrowed and I've sold. Now, let's say I sell it for $600. And so now I have $600 in my pocket that I didn't have any money to start with. I just borrowed a phone. So I got 600 bucks in my pocket, and the iPhone, 16 or whatever comes out, and all the old iPhones go down by halfway in price. So now that phone is worth $300. Well, I have $600 to spend, and now it's only 300 bucks. And so I go out and I buy the phone again. So now I've borrowed the phone, sold it, now I've bought it back. So I sold first and I bought second. And now
Gotcha.
I have the phone in one hand, I still have $300 left in the other. And then I do the final step. I say, "Oh, thanks for letting me borrow your phone. Here, Greg, here's your phone back. Call me if you need me, because I got $300 now." So I went from nothing to 300. Well, think about it. If it had been the opposite, if you'd have bought at 300 and it went to six, you buy at 300, sell at six, you make $300. Well, if you borrow and sell at six, and then you buy it back low for three and return it, you still have $300. You bought and sold at the same price. It's just borrowing it enabled you to have it in order to sell it as it went down. Well, the reason people don't know all four steps is because the brokerage does the first two automatically for you. When you click that button that says short the stock or sell the stock, if you don't have any of that stock or you didn't specify the shares you wanted to sell, when you click that, the brokerage does both for you automatically. They find some shares and sell it for you in one click. So it's actually four steps, but it's really two clicks, the sell and the buy. That's it. Just click the sell first. And when it falls, you buy it back later. Now, before everyone gets all excited about this, just because, look, right hand, left hand, I didn't say good and better.
Right, right.
There are some things about taking short position that are, it's definitely not the mainstay, and it's certainly a far riskier position if you want to talk about risk.
Yeah, it did sound a little bit like gambling. I get the iPhone
Yeah,
analogy because you can be pretty sure it's going to go down in value, but with a stock, I have
there
no
you
idea
go.
how you can predict the future.
There you go. So, well, first of all, there's a real problem with your directions here, because let's say I go out and I find a company like Ford Motor Company, and I own some of that, so I should know the price, but I think it's probably really cheap right now. I sold some puts to get some of it. It's under 10 bucks, I think, if I remember, under 14. I can't remember. Could be as low as 7. And so part of the reason I bought a bunch of that is it's so cheap. It's the best selling truck in America. Uh, there's just not a lot of downside to that. I mean, think about it. If I buy Apple at 180 or 185 or whatever it is right now, if I buy Apple at 180, let's say, and it drops 7 bucks, it could drop a lot further than 7.
Right,
Ford has to go bankrupt to lose 7, right? And so, if you look at the total of my account, a $7 drop in Apple is a drop in the bucket, and a $7 drop in Ford destroys the company. But to me, it's just 7 bucks. So I threw it out there because it's so cheap. What do you got to lose? Just 7 bucks. Go
right,
buy 1,000 shares. You get 7 grand at risk, right? It's not a big deal. You have that 1,000 shares of Apple. You're in 185. That's a little bigger deal, right? So when you own a stock, the most you can lose is if the company goes bankrupt. Okay. Now let's go back to our iPhone example. Let's just see how I can get really nailed in this. Okay. So I borrow your iPhone, and let's say it's an iPhone 15. It's brand new, right? It's one of the new ones. And then Tim Cook comes out and he says, this iPhone 15, it's in honor of Steve Jobs. We're not going to make any more of them. This is the last one you'll ever get. It's now vintage, and you can't get them anymore. In fact, we found that the phone business for us, hasn't been as lucrative as we want. We're going to go work on other stuff. So no more iPhones from us. Well, now if you like that brand and it's vintage, now that iPhone might have gone from $600 to $30,000,
right,
right, or
right.
40 or 50. Okay, now if I have to now I've sold your iPhone. I'm on the hook for an iPhone. I got to get this thing back, right? So how much am I going to have to pay to get this thing back and give it back to you? Whatever it takes.
Yeah.
So I have an infinite risk because there's no limit to how high the price could go. Now, infinity is a concept, not a number. There's never been a stock hit infinity. So it's a theoretical infinite risk. There's no such thing as a real infinite risk because it can't ever hit that.
Right.
Because it's just, but in theory, there is no limit on how high it could go. So I could definitely lose more than the $600, that I have in my pocket for selling the phone, right? I could definitely lose more than that by orders of magnitude. So
Gotcha.
if you get this wrong, you better have what we call a stop loss. You've got to have a stop loss or an option to protect you, or you could be in a world of hurt. So this is also maybe something interesting we talk about. I don't know, how are we to break? Are we close to break?
Yeah, actually, we are at break, and when we get back, you had mentioned to me earlier that there's two ways to do this to make money on a down stock. So I want to make sure
Yeah.
that we're getting the other way, but also just to make sure that we're showing both sides of the coin. I'd really like you to talk about risk management, things of that nature, which sounds
Let's
like the
do
stock
that.
is
That
probably.
would be wise.
So we'll hit that right when we come back for break, everybody.
Awesome.
Welcome back, everybody, to the Rich Dad Stockcast with Andy Tanner. There's some legal stuff that I should have done at the beginning of the show. So Andy is not giving us financial advice. Andy is giving us education. Andy may be talking about what he's doing, although even he said he doesn't do it often. But again, this is not necessarily what you should be doing. Has nothing to do with you in the audience. This has to do with pure education. We are not telling you what to do. Don't forget to leave a comment. Don't forget to hit subscribe. You can listen to the show anytime, anywhere. You can get it on, what is that, Apple. You can get it on Android. You can go to richdad.com and get it under the shows tab. Robert Kiyosaki likes to say, especially this show, because it does get a little technical, you always want to listen to things more than once because every time you listen or watch, you're going to learn. So especially Andy throws so much stuff at me. I take so many notes. But Andy, we did make two promises. We were going to discuss risk and risk management with shorts, but also you had mentioned there's another way to make money when the stock goes down.
There is. I'll give you an example from that's true to life for me. So do you remember, and some people watching this might not, the younger folks might not remember this, but back in the day, if you wanted to enjoy a nice movie at home, you get in your car. This sounds so antiquated and so silly to, like, my sons would never believe this. You drive to the video store and you'd walk through the aisles and you'd look at these physical videos and you'd pick it up at a place called Blockbuster Video is where you go do it. And you'd rent the video and then you'd have to take it back and pay the late fee if you didn't get it back on time, right? And my kids would be like, "What?"
Yep. And you had to rewind it or you got penalized.
Yeah, you got to rewind. And you could do that with DVDs or whatever. So you had Blockbuster Video, and Netflix just buried them. And Netflix started by mailing these, so you didn't have to go. And then Netflix started streaming, and Blockbuster Video just absolutely failed to innovate. They had this great brand. Everyone knew what the name of the brand was. If they'd have innovated, they'd still be around today, but they just didn't innovate. And they went bankrupt. Okay. So I did not short that stock, and I kicked myself for not seeing it because that's called obsolescence risk, right? So not too long after Blockbuster went out of business, I got looking at GameStop. And I'm like, GameStop is the same thing. It's Blockbuster Video all over again. GameStop sucks. And I started looking at their financials and I thought, man, these guys are waning. I'm not missing this again. Well, I didn't want to take a short position because of that risk we talked about. So what I did is this is a fancy jargon word. It's just a long-term option. What I did is I purchased a LEAPS, which stands for long-term equity anticipation security, long word for a long-term option. It was like a year, right? So I bought this. Now, this is really cool because what that does is it gives me the right to sell it at a certain price. So I have the right to sell high. See that? I have the right to sell high. So let's say Blockbusters, or Blockbuster, let's say that GameStop, I want to say it was around $12 or something like that. I can't remember what it was. I'm like, all right, $12, which really wasn't great because that's not a lot to fall, right? Like that Ford, that's
Right.
not a lot to fall. But I thought they suck so bad, their financials are bad, they're not innovating. We're gonna do this. So I bought the Leafs. What's nice is I have the right to sell it. I didn't actually sell it. I have the right to. I didn't have to borrow it. I didn't have to take that position. So my maximum risk now is the amount of money I paid for the option, my put option.
Right.
And if it goes up and my put option sucks, I'm limited to the amount I paid for the put option, and I'm not exposed to that infinite risk. And so that's really the way I prefer to do it. And we had was it Burry? Who was it that we were talking about last couple episodes ago that bought a bunch of puts? Was it Burry that bought them?
I think it was, yeah.
Yeah, and so he's taken a short position on the S&P doing the same thing. So he has limit to his risk on whatever he paid. Now it's big because he bought a lot of them. Well, what happened is that stock did fall, and so I was able to make my money. Let's say it goes from 12 to 5, right? $7 drop. Well, now the value of that put has an intrinsic value of $7. Why? Because now I could buy it at 7 with a guarantee to or sell at 12, right?
Right.
So I
Right.
can sell that option for the intrinsic value, never have to touch the stock. And I don't remember, those are not the exact numbers, but it was something like that where I sold it. Well, interestingly enough, a couple years later, all these guys on Reddit, who knows who started this mess, is they had seen these hedge funds take a short position on GameStop, and they weren't put options. They actually had borrowed the stock and sold it and were waiting for it to drop. And these guys said, "Hey, let's screw these hedge fund people." And so they got all the masses together on Reddit, and they started buying this crappy stock to force the price up, not because the company was good, but to force the price up. And they absolutely buried these hedge funds
Right. It was like
because the
the
price
David
is
Goliath.
$100 a share all of a sudden, right? It's like $300 a share or whatever it went to. And it was sad because those guys ended up losing money because at the end of the day, you have a company that just was dying. Now it did breathe life into GameStop because they were able, they were able to sell some of their own shares, and they're still bleeding cash. They haven't made money in years, and they're bleeding all that cash and trying to figure it out. But at least it'll give them the chance to innovate, maybe. But the moral of the story is you can do it two ways. You can make money when a price falls, and you can actually do it three ways. If you want to talk about options, options expire. So an option might be worth $1, and a month later it expire and be worth 0. That's a price that's falling. If it goes from $1 to 0, that's a price that fell. And I do that multiple times every single month. I sell it and then it goes 0, so I don't have to buy it back. If your iPhone became worthless, you would never want it back, right?
Right. Right.
So I can sell things and they go down and they go to 0 most of the time. When 90+% of my options that I sell, I never touch them again. They just go to 0, and that's cash flow. So there's all kinds of ways to make money when things go down. I would say this though, maybe the most salient thing is a real estate play, because we said it's specific to stocks, but in reality, it's actually maybe even more predominant in real estate if you look at it through a certain lens, because darn near every single person has a short position in real estate. It's just that if they borrowed money to buy the real estate, they're short the dollar. And
Right.
I love this concept. It's funny, I was at a conference and I had a booth or something with our company, and it was a real estate thing, and I had this big crowd of people around me, real estate investors that didn't realize that their risk was really the fluctuation of the dollar. They had no idea. Some of these guys were in syndications, accredited investors. I said, guys, you're not in real estate. You've borrowed the money. You don't own the real estate. The bank owns it. You've borrowed the money, and the bank can take that real estate anytime they want. They're really the guys that have the leverage on you. And if the price goes up, you're dead.
Yep.
Or excuse me, if the price goes down, you're dead.
Yep.
So you said something really important earlier, Greg. Really important. You said, "Well, you're really sure that the iPhone was going to go down in value." You had like 100% confidence in that, or close to 90 plus, right?
Yep.
Well, I can't tell you where the price of GameStop's going. I can't tell you where the price of Apple's going. I can't tell you where the price of anything is going. But there is one bet I would make if you let me make it long term. One bet I would make. It's not 100% guaranteed, but it's up there in my book. I bet that over the next 30 years, I bet the value of the dollar goes down. It's happened forever. You always hear grandpa, well, when I was young, you could get a hamburger for a nickel. And me, I said, well, I was young, you get one for 25 cents. My kids will say, oh, when I was young, you get one for $5. The value of the dollar is going to go down and it's going to buy less and less and less. So if you want to take a short position on the dollar, do those 4 steps, borrow some money and sell that money in exchange for a house. And now you got to pay the bank back that money, right? So rent the house and turn it back into money and then make a house payment and give it back to the bank. If you look at a financial statement, liability, asset, income, expense, there's 4 boxes, aren't they?
Yep.
Those 4 boxes represent a short position, borrowing the money, trading it for a house, trade it back into money via rent, and return it. So here you have this self-funding short position. You get funded by the cash flow from the house each month, but the money you're paying back to the bank after 30 years it's worth less. It's not worthless, but it's worth less when you give it back to the bank and return it. So you're really in a short position on the dollar. I think everyone could learn, like, this is good financial education. If you're going to be an investor in real estate, in stocks, in business, learning how to take a short position on things is huge. The reason, and I'm rambling a little bit, but the reason they call it a short position is, unlike that real estate play that is self-funding, because it cash flows, where it allows you to stay borrowed for 30 years, right? You can stay borrowed for 30 years.
Right.
The reason they call them short positions is they're not something that you would guess over the long term. For example, you would not guess that a company is going to take 30 years to die. If it survives for 30 years, it's probably going to go okay. So what they do is, if you bet on a company for 30 years, that's a long position, and it's a long period of time. So you're always going to be in a long-term position. That's where the term long and short comes from. The amount of time you're anticipating being there. So if I buy something, I would hope I'd be in it for life, right? There would cash flow, and you
Right.
buy a golden goose and it lays golden eggs forever, right? But a short position, the demise of a company, that's Blockbuster's going out of business. Yep. 6 months later, they're toast. So a short position is really about it's not the mainstay of what you're going to do over the long term. But it is fun. And I will confess, there are times where I will see something, that GameStop is a great example a few years ago, where I'm like, okay, these guys are not going to make it. And these can be broadcasted. Think about this, Greg. Back in the Obama years, the guy that ran against Obama and lost was Mitt Romney. And part of the debate they had in their debate was whether or not GM should go bankrupt, if you remember.
I do.
And they had these liabilities of pensions that they couldn't pay. And Romney's like, they slam the gavel, declare bankruptcy, all those liabilities go away, and you just reboot the company. What's so hard about that? And Obama's like, yeah, but then you got to turn these workers from pensions into 401ks, and that's a bad thing. We should try to work it out, right? And besides, politically, it just sounds bad to say declare bankruptcy, right? So Mitt Romney, not being very smart, he was probably right because he's a businessman, but politically it sounded bad, and people aren't educated, so they wouldn't have known, right? And so yeah, that's kind of the deal, where you can see a company like GM teetering for a couple years. It's really hard to find the Steve Jobs, Wozniak trade when they're in their garage, because they're small going big. But it's often easy to see the big about to collapse and go small.
Oh, that's interesting. So I don't want to put words in your mouth, but it might be easier to buy high, sell low than it is to buy low, sell high.
Sometimes it could be. Yeah, sometimes it could be. I mean, if you're a fundamental analyst and you see think about the people listening, if everyone showed me their financials that is listening to this podcast, right? Everyone on YouTube shows me their financials. We're going to pick out some folks that are struggling. We're going to say that guy's going down, right? He's
Yeah.
toast. He's going down. So let's bet on that and let's make money as it goes down, right? So that's kind of how that stuff works. And I will absolutely take a short position on options. I'll buy puts sometimes speculatively. It's not a mainstay. The
Right.
only short positions like I have right now are short calls that are covered by stock. So I don't have the risk. I can sell that, and if they call me out, great. I have the deliverables. I don't need to buy it back yet. So buy it back late.
So don't tell me which stock if you do have this, but do you have any shorts right now?
Mm-mm.
No,
Nope,
nothing's
not
like
at all.
jumping out at you.
No, the other way I might short, this is important. The other way you might take this is as a hedge. Like, for example, in our Mentor Club, we have some put options on the S&P 500, not because we think the S&P 500 is going to drop, but because we think it might. There's a
Mhm.
difference there. I buy insurance not because I think my house is going to burn down. I don't think this place is going to burn down. What I do think is that it could, and so I have insurance. So you could also learn to take a bearish position. You could buy some put options as insurance because they don't cost very much, and you can have a lot of leverage that way. To where if the market were to melt down, you'd be protected, which would be a great idea for our next podcast. Is because there's a lot of people that think there's a debt bubble. A lot of people think this thing could collapse.
Yep.
How would you protect yourself? Well, you'd need to make money when prices were falling to counteract any money you'd lose by your long positions.
It's funny. I was just going to say, I think you're heading into a whole world that's going to require a lot of detail and a lot of thought. Well. So are
take the
those
web
stocks
class.
yeah, that's what I was going to ask, because I don't think you can cover all that in 30 minutes. But that's what I want to know is the web class. It's in the description, in the notes. But if that covers that.
Yeah, I mean, we've got there. It's so exciting because if you're a financial education junkie like I am, this is a whole world of education. Matter of fact, I know we're getting close to time to close the show, but just think about this for a moment, if you could. If you look at we're usually talking about cash flow, but if you talk about net worth for a minute,
Yep.
there's two ways you could make your net worth go up. You could buy something that goes up in value in your asset column. Yes.
Yes.
Okay. Your liability column is things you borrowed, right?
Mm-hmm.
So if you borrowed something in your liability column that went down, what would happen to your net worth? Think about that. If your asset column increased, definitely your net worth would increase, right?
Mm-hmm.
But if your liability column decreased, what would happen to your net worth? It would increase, right?
Yeah.
Do the
Completely.
math. Yeah, do the math. So you have two ways to build what net worth now. You could buy things that go up in value, or you could borrow things like cash that go down in value. Well, which is easier to do if you have no money? Well, if you have no money, buying stuff that goes up is out of the question because you got no money.
Right.
So if you have no money, what's easier to do? Buying or borrowing? Borrowing. How much can you buy? You can only buy what you have on hand. How much can you borrow? You can borrow as much as someone will loan you. So actually, a person can get rich faster, much faster, by debt, by borrowing the dollar that's going down. So if you ask someone like Kenny and Robert, why do you love debt so much? Why are you always talking about debt, debt, debt? Oh, I love debt. I love debt. Well, because there's no limit to how much debt you can go in, how fast you can go into. And as long as you're borrowing something that's decreasing in value, your net worth is going up. Even though their focus is cash flow, the very structure of that is also making them into $100 million guys because of the liability column. Isn't that kind of crazy?
That is
So
completely
this is really cool financial education, and it takes the asset and liability column out of good and bad. Asset good, liability bad. Nope, left hand, right hand. You can use either one. Left hand, right hand. Buying good, borrowing bad. Nope, just depends. The determining factor is which direction it goes. Buying can be bad if the price falls.
right.
Right? You put a lot of money in something, it falls, you're getting poorer. So it's not about assets, liabilities, buying and borrowing. It's about the direction, right, that things go.
Well,
Really
to me,
cool.
it's about a way to get started when you don't have a lot of money, which to me is super exciting. And I think to the audience, that'd be really exciting too, because people here are just starting out and you just kind
Particularly
of
in
go to
real
the
estate. Yeah, you can do it in real estate, particularly in real estate, because the house provides the collateral itself, so you can
right.
borrow as fast as you could borrow. Yeah, it's cool.
That's
It's
great.
way cool. Yeah.
It's way cool. All right, everybody, go to the show notes and learn how to short. Sounds like a great way to get started, although make sure you get educated first.
Paper trade, please. Paper trade, please. Practice, please.
And Andy, we'll see you next week, man. Thank you very much. Oh, one thing.
A lot of fun.
There's no Andy rant. We went a whole
Oh
show.
my
No Andy
gosh.
rant.
You know
You're
what?
clearly
I
not
guess I
feeling
must
well.
I must be under the weather. You know, my frog in my throat's preventing rants today. So
Well,
I'll
we'll try
rant
to get
on people that don't paper trade first. How about that?
We'll get that next show. Thanks, Andy.
Thank you.
All right, bye.
Podcast is a presentation of Rich Dad Media Network.